Emerging markets like Brazil, India, and Mexico are balancing free trade and protectionism to compete with China's exports. Last year, foreign direct investment into China fell to a 30-year low. In response, China is investing in high-tech goods, exporting them to the global markets. The average price of Chinese manufactured exports fell by nearly 10% from 2022 to 2023, with export volumes reaching near record levels. To counter this, the Biden administration imposed tariffs on various Chinese goods, including a 100% levy on electric vehicles, on May 14. Emerging markets are introducing import restrictions on Chinese goods while pushing for free trade with other countries. Mexico's market share of Chinese-made vehicles grew from negligible in 2016 to a fifth of the market. Mexico raised tariffs on 544 products in April, including an 80% levy on certain steel imports. India has launched numerous anti-dumping probes, including on unframed glass mirrors and fasteners, and has filed the most anti-dumping cases globally. In March, Chile's largest steel producer, CAP, decided to wind down its mills due to Chinese import competition, leading the Chilean government to impose temporary anti-dumping tariffs of 25 to 34%. Emerging markets are also signing trade deals to access larger markets. Chile signed a trade deal with the EU in February. Mercosur, a customs union including Argentina, Brazil, Paraguay, and Uruguay, signed an agreement with Singapore and is negotiating with Japan and South Korea. India has signed 4 trade deals since 2021, despite failing to complete any in the 7 years prior. This strategy aims to protect domestic manufacturers until China's subsidy wave subsides. Despite these efforts, some Chinese goods remain cheaper even with high tariffs, and some products bypass levies by being packaged in third countries. Thailand is enticing Chinese battery firms with incentives, expecting 2 big cell manufacturers to start production this year. BYD, a Chinese electric vehicle maker, is building factories in Brazil and Hungary. Although foreign direct investment into China has dropped, Chinese investment in other countries has reached an 8-year high. The sustainability of China's export surge is crucial. Production costs in Indian plants have become competitive with Chinese ones, suggesting a slow shift in production. However, concerns remain about China's long-term capabilities, given its 25-year track record. Western countries, meanwhile, are also implementing subsidies to revive domestic manufacturing. American tariffs on Chinese goods cover only a few categories worth $18 billion in current imports, meaning Chinese competition will persist in other areas. Emerging markets must navigate these complexities, balancing protectionism and free trade to foster manufacturing growth while mitigating the impact of China's economic strategies.